hopefully super helpful to investors in the room as well as people that are founders and looking to connect with investors. Hope you enjoyed it as well. Let's give our panelists a big round of applause as our next speaker comes up. Thank you. All right, our next speaker is Charles Williams from Pioneer Realty Capital. He's the CEO and president of the firm and PRC Equity Fund, and will be presenting on PPPs with Texas Public University Systems on how investors can access the opportunity. Thank you, Charles. Appreciate it. Let's give him a round of applause.
All right.
Thank you.
Thank you. Thank you. You guys enjoying the show so far, the forum? One person said yes. Okay. So imagine having a child who's worked hard to prepare to attend a Texas Public University. They've gotten great grades. They've joined all kinds of associations. They have all kinds of awards. And they're accepted in a Texas Public University. And they're excited. They show up to campus, and then they find that there's no place for them to live. Can you imagine how disappointed they must feel? Well, that is a situation that many individuals who want to attend Texas public universities have to encounter. You see, there's a shortage of student housing. PRC Equity Fund is solving that problem in a public-private partnership with Texas public universities. The university signs a master lease, and we develop student housing. Now, that's interesting to you as an investor because there are some unique features associated with this. One, we have no vacancies. We have no delinquencies. We have no evictions. And we get paid 6 months in advance every 6 months. I would say that's a pretty good investment. I want to tell you about this investment. I want to go through our investment deck, and I ask that you give me your attention. But first, let's start off with a video, if I can figure out how this works. There's a clicker here somewhere.
PRC Equity Fund develops on and off campus student housing in a public-private partnership with Texas public universities. In this partnership, PRC Equity Fund develops student housing, and the public university system guarantees rent payments by signing a master lease agreement for up to 30 years. With a minimum investment of $5,000, you can be a part of the solution and benefit from this initial public offering of publicly traded securities. PRC Equity Fund targets an annual 10% return paid monthly. Additionally, investors share 70% of the annual profits from the fund. Reserve your spot today to take advantage of this unique investment opportunity. Invest today.
So our offering summary, we're raising $75 million. The minimum offering for this fund is $1 million or 1,000 Class A investment interest. This is a Regulation A publicly traded security. Our total raise we are seeking is $75 million. As you may have seen in the video, we are targeting 10% annual dividend. We actually escrow that dividend as we collect those investment dollars, and that's held by our transfer agent who makes sure that our investors get paid their dividend. And then there's a 70% split to investors. Now, as I mentioned, there are 6 public university systems in the state of Texas. So a university system, for instance, like Texas A&M University, there are 11 universities in the Texas A&M University system. And each of those schools require student housing on campus and off campus. We focus on providing off-campus housing for those students that are not required to live on campus, but need housing all the same. Now, the problem that we're solving is what I mentioned in the beginning, that right now in the state of Texas, the universities and the students who seek to attend those universities are dealing with a long wait list for on-campus housing. As a result of the high demand for housing in the market, they're faced with very high rental prices. There's a lack of affordability in the community. There's inadequate maintenance and upkeep of some of the facilities that are in the market. And as a result, you have this rising demand and you have limited supply. Now, we know what happens in a market like that. Prices go up. They go up significantly. But how does the university mitigate that? Well, they enter into a long-term master lease, which allows us to capitalize that project at a very attractive rates. And it allows us in this public-private partnership to solve some of these problems. Now, there's an increasing enrollment demand in the state of Texas. There are currently 148,554 students. We're seeing this growth increase about 11.4%. If you don't know, in the state of Texas, the current population in the state is about 29 million. Here in the next few years, it's expected to grow to 36 million. Another interesting fact about the state of Texas public university system, the University of Texas recently announced that if you have a household income of $100,000 or less, your students get to go to a Texas University of Texas school for free. So that opens it up for about 7 million households. Question is, where are they going to live? And that's what this fund seeks to address. Our primary customer and our primary assets are currently in our partnership with the Texas A&M system. If you look at this map, you're going to notice something very interesting about where these universities are located. They're mainly located in tertiary markets. Now, what that means is that developers aren't likely to go to these small markets and develop off-campus housing because for them, it represents risk. But for PRC Equity Fund, Pioneer Realty Capital, we will. The reason we will is because our project is supported by that long-term master lease. So this is a proving partnership model, the public-private partnership. This is something that government has used for a long time to offset the risk to the developer so that they can satisfy the needs of the government or for their citizens. And the same is true here. There's a long-term value of money. There's off-balance sheet financing available to them. We can deliver a lot faster than their bureaucratic system. We provide access to that private capital. That's why we're raising the fund, to make sure private capital is there for pre-development costs. And there's shared risk and responsibility. But more importantly, educators are in the business of educating, not in building buildings. So they get to take advantage or leverage our expertise in construction and construction management. Well, the most important thing is, how does the fund make money? As you recall, we are representing 10% preferred rate of return, annual return to the investor that's distributed monthly, and 70% of profits. Well, how does the fund generate income to pay those returns? Well, this model hopefully will help you to understand. I'm going to give you an example. A typical project, we have a phase 2 of our Prairie View project, and that project is roughly $85 million that we're starting construction on here pretty soon. Now, the pre-development cost, that's the cost that's required to get us to a master lease agreement, can sometimes be $2 to $3 million. The fund provides the capital or bridge capital for the pre-development expenses. But and then we close a bond transaction upon receiving a master lease from the university. When we close that bond transaction, the money from the bond replenishes the money to the fund at a 2x multiple. So you can see that the fund is more transaction-based. The more projects we do, the more money is returned to the fund at a 2x multiple. And so that's one of the ways that the fund makes money. Then once we finish the construction project, there's money left over, right, from the bond proceeds. Well, once we get our C of O and that lease commences, then that excess cash goes back to the fund. That's the second way that money goes to the fund. And then, of course, there's rental income. Once that property is paying rent, we make our debt service payment on the bond, but there's money left over, well, that goes to the fund as well. And because we are required, because of the way our fund is set up, to hold cash balances, we earn interest on those cash balances. So that's how the fund, that's a fourth way that the fund makes money. So we kind of went over this just to repeat. The pre-development process, our pre-development costs includes land acquisition, third-party reports, design consultants, legal for getting the bond closed. So all of that's funded or bridged in a way from the fund. But that fund receives that money back once we close the bond transaction. Now, and of course, again, you'll see an illustration of this as well. We explained it a couple of different ways because sometimes people miss it. There's a 2x return paid back to the fund from the closing of the bond transaction upon closing the bond. Now, before we get into investor return metrics, one of the things I want to explain, because we talk about this municipal bond transaction, and often the question I receive when discussing this with potential investors is, well, how does the bond generate so much cash? Well, if you're in real estate, you know that we value an asset based on its cash flow. We take the NOI, we divide it by a cap rate, and that tells us the value of that asset. Well, what you're really valuing is the cash flow stream from that asset. And the same is true in the municipal bond market. We determine the value of that cash flow stream, which comes from the master lease, based on the yield that we're paying on the bond. So we simply take the cash flow, divide it by the yield, and that tells us the value of that cash flow stream. So I may have a project, for instance, my project that we're building now, that's $85 million. We're closing a bond in February for $125 million. So that $125 million, a part will be used to build our phase 2. There's another part that replenishes the fund, and then the remainder of that cash, upon completion of the project, is distributed back to the fund in the form of profits. And so that helps you to appreciate how the fund generates money. And so the more transactions we do, the more money the fund makes. And it represents significant returns because we're closing these bond transactions in about 6 months from conceptual to the actual master lease. And so the internal rate of return of that cash back to the fund is significant. It's certainly notable. So let's look at some of our investor metrics. Right now we have, for the year 2025, we have 1,625 units that will go into development at various stages for the year 2025. And each year we're putting anywhere from 2,000 to 2,500 units in the pipeline each year. Now you may say, man, that's a lot of units. How are you doing that? Well, think about this for a second. It is not as much as you think it might be because of the fact that each project is about 500 units, and in one case, we have a project that's 900 units. So we're only putting 2 or 3 deals in the pipeline each year. And so as these deals transact, it creates revenue back to the fund. And, you can certainly download this investment deck, and I can go into these numbers in more detail. I want to reserve a couple of minutes for questions. So, again, this is our current pipeline. This is actually understated, but these are the projects that are in our development pipeline. And so we have a very healthy pipeline of deals that we're doing in partnership with the Texas Public University systems. And so that represents guaranteed rent opportunities in those particular projects. I wanted to go through a case study of one of our projects, but again, I wanted to leave just a little bit of time so that you guys have an opportunity to ask questions. Any questions at this point? I can't see, so you just have to.
How many units do you have under management
Right now, we have our one site that has 120 units that's under a master lease agreement with Texas A&M University. We're in the process of constructing phase 2 to that, which would be 450 units. And in our development pipeline, we have roughly 1,600 units that we're starting development work on.
Charles, it looks like much of this depends on the bond. Can you give us a little more color on
Yeah. So we have 19 seconds. So if that's a very good question, my table that our table is right behind us. Please come and I can go through that entire process with you, how it works. Very interesting question, but these are 2025 series bonds, and it's very interesting how these are put together, but I can answer that question for you. We'll take one more.
Right here, right over here, right over here. Oh, one second.
Okay, I can't see anything, so just start talking.
I didn't hear the question, but I probably had that same one. Is who's the counterparty on the bond?
Yeah, so our bond underwriter is Morgan Stanley.
Right, but
Yeah.
okay, who's buying the bond though?
The-
Public.
These
It's a
are,
public.
these are tax-exempt municipal bonds that are being sold to municipal bond investors
Got
who
it.
like buying a cash flow stream backed by a Texas public university.
Got it.
No, the sponsor is so that's, your question is who's the issuer of the bond, right? And so so you give me the right question, I'll give you the right answer. So the bonds are being issued through a nonprofit, and that's how we get the tax-exempt municipal bond structure. And just so happens we control a nonprofit.